actually talks about, besides the electronic payments specifically mentioned on the right, we actually have many different new models of financial services. The most commonly heard term now is called scenario finance. Scenario finance means that our original understanding of a bank is that it is a place, a bank is a place, and on this physical channel, it provides financial products and banking services. But gradually, bank turns into banking. Banking means that you have a kind of financial activity because there are people who need financial services. However, because we now have these mobile devices in various application scenarios, through mobile devices in different application scenarios, which application scenarios? Including personal life and work, or in business operations, whether you need a loan or to make a payment, there are different application scenarios. In life, you have food, clothing, housing, transportation, education, and entertainment. At work, you might need accounting functions or financial planning functions. So these different application scenarios can immediately connect to those who can provide financial services. So the meaning of scenario-based finance is that the initiation of financial services shifts from a physical location to whenever you want to engage in financial activities, allowing you to access financial services anytime, anywhere. There are several financial technologies, including the commonly heard ones based on blockchain technology, such as cryptocurrency and smart contracts. But in fact, there are some technologies that don't seem so advanced, but are currently being implemented. For example, starting from the bottom. We no longer need to go to a physical bank to open an account. As long as you can use online services, you can open a digital account. You can also go to a purely online bank, which is a network bank without physical branches, to provide you with a digital account, allowing you to enjoy such services online. Now, there's also another aspect, which is that this kind of service is gradually introducing smart finance. Smart finance means incorporating smart technology, such as chatbots or artificial intelligence. Chatbots are easy to understand. In the past, when we called customer service or had any questions, we would usually seek help from bank staff or search online, right? Then, when you search online, you might have to look up the Q&A yourself. But now, many banks have their own line or their social media or website where they provide chatbots with many preset questions and answers. It will come up and ask you, do you need any help now? You ask it questions, and it's like a real person on the other end of the internet or phone interacting with you in that way. It's similar to how our early banking services evolved from interacting with a teller to using an ATM. A TMS allows you to withdraw and deposit money, and you can also perform other operations like transfers, gradually transitioning to online services. The smart technologies provided also include, for example, many that emphasize artificial intelligence, where you apply for a loan or purchase some financial products. He can use artificial intelligence to assess your actual personal credit conditions and past spending records. So there is no need for a dedicated physical financial service personnel to calculate or check if you meet the conditions and determine the loan amount and interest rate. So these things are already intelligent and automated. The government is also promoting open banking. Open banking does not mean opening the bank for everyone to enter. It means that all banking operations have an open standard. An open standard means that other non-financial technology companies can use technical integration called API, which stands for Application Programming Interface. So as long as your application interface is compatible with the standard, you can connect to the bank to obtain information on products, transaction records, or personal credit, and so on. Of course, it is opened in stages. So up to now, like when we are trading stocks, we know we can connect to the stock market prices, company information, and design the most suitable interface for your target audience, the one they want. In the area of financial innovation, the part we are most closely involved with is still in payments. So here, I will introduce a study we conducted, which is very interesting and coincidentally aligns with what we are discussing about competitive dynamics. Competitive dynamics refers to a series of actions and responses between firms. If we consider electronic payment institutions as these firms, and these e-payment institutions have a characteristic of being a platform model, the main driver of platform operation is network effects. At this point, we need to review what network effects are. Network effects mean that the more users there are, the higher the perceived value of the product or service. So network effects are about the number of users. The more people using the same network, the higher you perceive the value of the products and services offered on that network. It's very much like a simple example, which is the mobile communication network, that is the mobile phone number. The number providers usually offer a service where calls within the network are free. Free calls within the network are a great way to drive network effects.
Why? Because the more users you have, the higher the value of your telephone communication service becomes. Offering free calls within the network, your goal is to encourage users to try other free in-network services after using this one. For example, if I call you tomorrow and say, hey, Aaron, I've tried your product and I didn't really like it. Can you introduce me to your product? I'll call you back to ask about it. This is a way of in-network interaction where a single user can bring in more users.
When you and your friends can call each other for free within the same network, for example, if my daughter wants to get a mobile phone, we would of course hope that her phone number is with the same telecom company as her parents. This way, she can enjoy free calls within the network. What is the benefit for the telecom operators? When it has more users, it doesn't care about free in-network calls, because when your number of users increases, it's impossible for all calls to be in-network, so there will definitely be other expenses. When the number of users increases and the spending amount is higher, you can spread out the investment in fixed equipment and technology. So it can offset its original fixed investment, which is why having more users is better. So it creates a feeling that using this product or service becomes more valuable as more people use it. This network effect is actually the core of all platform models. The platform business model most commonly seen in our past life experiences is actually like a night market. A night market is a platform because the operator brings in vendors on one hand and does a lot of advertising to attract tourists on the other. When we want to visit a night market, which one do we choose? We tend to choose the one that seems to have more people visiting, right? Or if there are more vendors inside, you will be more inclined to go. If there are more people visiting, you will be more inclined to go. This kind of network effect is called a same-side network effect, because on the same side, we are all visitors, and the more visitors there are, the higher you perceive the value of its goods and services. This is on the same side. If there are more vendors, you will also feel more inclined to visit this night market. So this is a cross-side network effect. The more cross-side and same-side network effects there are, the more popular the platform will be. It's like climbing stairs. Platform models work this way. On one hand, they need to stimulate, like if it's an e-payment platform, they need to stimulate at least what? Stimulate consumers and stimulate merchants. So it wants to have more merchants signing contracts to cooperate with it. For example, those accepting Pay or Line Pay money. If there are more such merchants, and if the consumer is a user of Pay or Line Pay money, then when you go to that merchant, you can use electronic payment to pay.
So the actions it usually takes are either offering some points rewards to consumers or giving you some discounts.
As for the merchants, it's the same. They say, hey, I won't charge you a platform setup fee initially. If your transaction amount or the number of transactions reaches a certain level, I might offer you a discount on the service fee. So far, platforms have been charging merchants. If you want to accept Pay or Line Pay money, then you have to pay the transaction fee.
Currently, charging platform service fees is still relatively rare. Most fees are based on your transaction amount, generally between 2% and 3%. But what do you save? For merchants, the benefit is that they don't need an additional physical POS system. This e-payment platform will handle the checkout, saving you a lot of effort in controlling and managing cash flow.
Okay, so you enjoy the benefits, and it also helps attract consumers who use such electronic payment tools, as they will be more willing to come to your store because they enjoy this convenience. For consumers, if I have such an electronic payment tool, I would naturally want to look for merchants that offer this service.